Robert Childs again from Financial Market Advisors. Last segment we talked about credit restoration, how to keep your credit scores high, etc. Today we're going to talk about collection agencies, paying off certain collection accounts, which is important to know on how to maintain higher credit scores, and also your rights to get the collection agencies off your back, especially today in a bad economy. They're stepping up the collection efforts. I've never seen in the last 20 years, more so in the last couple of years. In October of 2005, October 17th, Monday 2005 to be precise, they had changed the bankruptcy laws in the United States. Prior to that, it was fairly easy to file bankruptcy. Today, you have to go through credit counseling with a nonprofit hired organization before you can file, and then the bankruptcy judge will look at it to say, you know, this is the do's and don'ts of what you can file on certain debts. Either a Chapter 7, Chapter 11, or a Chapter 13 bankruptcy. But the important thing is, if you owe money on a student loan, a credit card, even a mortgage, your house went into foreclosure, and the difference from what you owe versus the value of the property becomes an unsecured debt, especially on second mortgages, it's imperative to know your rights under the Fair Debt Collection Act laws. The FCRA, the Fair Credit Reporting Act laws, protects you from mistakes that the credit bureaus make on your report. We talked about last segment. This segment we're talking about the FDCA, the Fair Debt Collection Act laws. In 1998, they were revised by the federal government. In 2008, with some other minor changes, that says that there's a statute of limitations on these debts. Now, except for IRS taxes, certain student loans, state or federal student loans, child support, and unemployment repayment, they take a very long period of time. I'm talking about upside-down car loans, credit cards, possible upside-down second mortgages after property was taken to foreclosure or short sale where there's a balance left over. These private debts do have a 2 or 4 year, not 2 to 4 years, but 2 or 4 year statute of limitations. It's 2 years in California law and 4 years by federal law. It varies state to state. What I mean by that statute of limitations, let's say you owe a bank $1,000 on a credit card, you haven't made the payment for about 6 months, and they sell it to an outside collection agency. Either from that 4-year clock, I'm going to talk about federal law, when that 4-year clock starts to tick, is either when the bank puts it in the charge-off state, it says charge-off on your credit report, or when they sell it to an outside collection firm, or like a law firm or an outside collection agency. That's when the 4-year statute of limitation, a 4-year clock starts to tick. Now, for example, if you owe $1,000 and they put in the collections, let's say January of 2010, well, come February 2014, plus 1 month, if they are unsuccessful to collect any money from you, you legally do not have to pay that debt anymore. Now, that may not be 100% true in some other cases, depending on the debt. Don't hold me to that. Usually, 9 times out of 10, certain credit card debt, most credit card debt, upside-down automobile loans, and certain other types of unsecured debts may have that 4-year statute of limitations. Your chances are very, very high. Now, if the debt's only 2 years old, a lot of cases, settling it might be the best way to improve your FICO score, especially if you're trying to buy a house, if you're trying to land a mortgage. I'll give you an example. If you owe $1,000 to a bank and it says past due $1,000, make them an offer. If it's already charged off as a loss, by calling up and saying, bank or collection agency, I'll give you $100, roughly 10 cents on the dollar, to settle the account. If that happens, make sure that you get a payoff letter, because commonly I've seen over the years, person, pays it off out of escrow, or they negotiate direct with the collection agency. Years go by, and it still shows an open debt on the report 2 years later. Earlier in the last segment, we talked about credit. You got to check your credit report 3, 4, 5, 6 times a year to make sure it's accurate. Because, like I said, about 86% of the time, according to Fair Isaac, mistakes are on your report, and that includes debts that you had paid off earlier, and it still does not show as a paid-off debt on your credit report even 2 years later. Make sure that you keep that payoff letter or settle letter from the creditor or collection agency for at least 4 years to make sure you cover all your bases. Because you owe $1,000 and the credit report a year later says $1,000, and they're going to say, wait a minute, John, you didn't pay off that debt. Well, no, here's proof of. It might take a month or two to get it cleaned up and straightened up with the credit bureaus. In the meantime, you're trying to get yourself a mortgage or a refinance. Rates go up, payments go up, and you missed the boat on a low rate. So please know what's on your credit report at all times. Agencies under the FDCPA Fair Debt Collection Act laws, there's a certain limitation what they can and cannot do on a daily and weekly basis. First off, collection agencies can only call you once per calendar day. There's a limitation of time on Sundays, which I won't get into. It'll take too long to explain that. But 7 days a week, they only can call you once per calendar day. Now, they can call and hang up. If they do not leave a message, that does not count as call number one for that given day. They can call your work, home, and cell number all they want, and also they have to call from a revealed phone number. They cannot block their phone number. It's against the law. If they leave you a message at, say, at 8 o'clock in the morning, and someone calls back from the same collection agency, different person, at 12 noon, and leave you a message, or you pick up the phone, they just broke the federal law, and they most likely can be sued for harassment. Collection letters, they can send as many as they want. That's a very non-verbal communication tool, what they use to try to collect that debt. Also, under the Fair Debt Collection Act laws, they cannot call you before 8 a.m. or after 9 p.m. unless they have your permission. So if you say, well, it's 8:55 p.m., call me back at 9:30, Mr. Collection Agency, which usually doesn't happen, then you gave verbal permission, that call was being recorded, and they'll call you back at the time that you say call back. But don't be afraid of dealing with collection agencies. A lot of people are afraid even with the IRS. You'll find that the IRS is very user-friendly, even these collection agencies. Another important key element to know is that if a collection agency lies to you, let's say, for example, John owes $1,000, it's in collection, but they use false tactics to try to get a hold of you because you're avoiding their calls. And they say, this is Billy Bob calling, and this John's long-lost cousin from Florida, and then all of a sudden you get on the phone, and they say, guess what? Oh, this is John. This is Bill calling from collection agency ABC. That is against the law to lie. They also cannot use bad language and threaten you verbally. That's also against the law. Not only that individual could be arrested, but also the company can be sued. Most important thing to know is that paying off your collection accounts will improve your FICO score. Ultimately, if you're trying to close a mortgage and based on your debt-to-income ratio, the lender may say you got to pay off this certain debt. Very crucial to know that. Another thing, too, that you want to be careful with, because a lot of lenders don't know this, is that depending on how old that debt is, that you want to be careful how you walk in the minefield, so to speak, paying off certain old collection accounts. Now, by federal law, an account that's good or bad can only stay on your report for 7 years. Bankruptcies and certain tax liens for 10 years, inquiries for 2, but most part, even an account in good standing closed by you or them, 7 years and 1 day later, it better be off the report. So let's say, for example, you owe a credit card $1,000 and it's 6 years old, but the DLA, the date of last activity, is from 6 years earlier. Let's say in this case 2004. So in the year 2011, the account's going to fall off the report. Lender says, John, you got to pay off that $1,000 before we can close your loan. Well, you negotiate, you settle it, or you pay it full, doesn't matter. And then when they run your credit report a month later, the score drops, let's say, for example, 40 to 60 points. You say, what happened? Well, any account from the date of last activity, okay, it says on the report, or open date, date of last activity is 2 or less years old, it will not have a negative impact on your score by settling it. But in this case, in this example, it was 6 years old. Now you woke it up. Instead of falling off, let's say in the year 2011, you extended it for additional, 6 years, plus the 1 year, and now it's not going to fall off until the year 2016. You just updated it, you lowered your FICO score, and guess what? The lender didn't know that, and you did not get approved for your loan, for example. So take a look at that, and you're welcome to call me, because we do give a free consultation over the phone on your credit. We'll talk about, credit rebuilding, credit cleanup, and also what debts to settle or what debts not to settle based on the statute of limitations. And the lender says to you, you got to pay off these certain debts before we can close your loan. Talk to me first. Very, very important to know. One last thing I want to mention about collection agencies is that